cost of equity. Cost of equity. Cost of equity means expectation of equity shareholders. Expectation on equity shareholders return is called a cost of equity. Cost of equity we can compute it in four five methods. K, constant, first method, constant earnings approach. What is constant earnings approach? Constant earnings approach, K is equal to EPS divided by MPS. EPS means earning per share. I think you know how to find out EPS. What is it? How to find out EPS? Profit available to equity shareholders divided by number of equity shares. Suppose one company's profit is 20 lakhs. 20 lakhs is profit. Profit available to equity shareholders 20 lakhs. Clear? Number of equity shares are 2 lakhs. 2 lakhs. Then EPS will be profit available to equity shareholders 20 lakh divided by 2 lakh number of equity shares, rupees 10 per share. 10 per share. MPS means market price of share. Market price of share. Suppose for one share my EPS is rupees 10. For one share my EPS is rupees 10. Suppose this share price of market price of share of this company, market price of share of one share of this company is rupees 80. What is rupees? Market price of share is rupees 80. In that case, an investor can purchase one share by paying rupees 80. For return, for the investment, he can get return of rupees 10. For one share, earning per share is rupees 10. Then K is equal to 10 divided by 80 into 100. If you mention in percentage, express in percentage, 10 divided by 80 into 100. Yes, what is the percentage? 10 divided by 80. What is percentage? 12.5 percentage is the K. 12.5% is the K. Clear? Clear. This is the first method for finding out K. Question specifically gives you only EPS and MPS, market price of share. You can find out constant earnings approach. In that approach, K is equal to EPS divided by MPS. Clear? Yes. EPS means earning per share and MPS is market price per share. Second formula, constant dividend model. Constant dividend model. In this constant dividend model, D divided by P0. P0 means current market price. P0 means same MPS. Market price of share is called P0. That means current market price per share. Current market price per share. Current market price per share. Clear? Under constant dividend model, okay. Constant earnings approach, EPS divided by MPS. EPS divided by P0. Constant dividend model, instead of EPS, they will take D, dividend per share, DPS, dividend per share. Suppose the same example. In previous example, as we know, EPS is rupees 10. EPS is rupees 10. This EPS means earnings per share. This full earning per share will not be paid to the shareholders. EPS is rupees 10. Suppose 60% of this EPS may be paid as dividend. In that case, dividend will be 10 into 60%. That is rupees 6. That is rupees 6. This is called dividend per share. DPS. This is called a dividend per share is rupees 6. Clear? Clear? Yes. Rupees 4 company retained in the business. That is retained earnings per share. Retained earnings per share. What is retained earnings per share? Rupees 4. Rupees 4. Okay. Under constant dividend model, DPS divided by MPS or D divided by P0. Dividend per share divided by market price per share. Dividend per share is in this example 6 rupees and market price per share we already previous example we discussed MPS is rupees 80. 6 divided by 80 into 100. What is the percentage? 6 divided by 80 into 100. Yes, 7.5. 7.5 percentage. 7.5 percentage is K. Clear? Clear? Okay. Okay. Again, one more point I'll discuss. EPS is rupees 10. EPS is rupees 10. DPS is rupees 6. Okay. What is dividend payout ratio? What is dividend payout ratio? Dividend payout ratio is 60%. Dividend payout ratio is called a dividend payout ratio. How we got this dividend payout ratio? DPS divided by EPS. DPS divided by EPS. 6 divided by 10 in 100. 60%. DPS divided by EPS. Dividend payout ratio. Clear? 60%. How we got DPS? 10 into 60%. 10 into 60%. Rupees 6 is dividend per share. Rupees 6 is dividend per shares. Rupees 4 is retained earnings per share. Clear? 60% is dividend payout ratio. 40% is called retention ratio. What is 40% is called a retention ratio. 10 into 40%. 4 rupees retained earning per share. Clear? 40%. How we got this 40%? 40%. How to find out retention ratio? 1 minus dividend payout ratio. 1 minus 60%. 40%. Clear? 100 minus 60, 40. Clear? Yes. Then under constant dividend model, DPS divided by MPS or D divided by P0. That is the K. Clear? Yes. Suppose question specifically gives you an only dividend and market price per share. In that case, the constant dividend model you can find out DPS divided by MPS or D divided by P0 for K. Clear? If question gives you only EPS and MPS, earnings approach. Clear? EPS divided by MPS. Clear? Okay. Next method, important method, dividend growth model. Growth model. This method, again we will discuss in dividend decision chapter. Okay. Most of the concept we will discuss from here itself. Dividend growth model. Under dividend growth model, K is equal to D1 divided by P0 plus G. D1 divided by P0. What is D1? Expected dividend. D1 is called a, what is G? Growth rate. Suppose one company, A limited company, that company is running for past 5 years. The 5 years say company has some growth will be there yearly. Some 10%, 20%, 15% growth will be there. This growth rate is called G. Each year growth rate is called a G. Growth rate. Clear? Okay, G. What is P0? Market price, current market price per share. What is D1? D1, expected dividend at the year end. D1. Expected dividend. Expected dividend. Clear? Okay. How to find out D1? D1 is equal to expected dividend. Okay. D1 is equal to D0 into 1 plus G. D0 into 1 plus G. D1 is expected. Suppose company is paying 6 rupees dividend current year. 6 rupees dividend current year. Company's growth rate is suppose 10 percentage. Suppose 10 percentage. In that case, an investor is expecting that they will get some more dividend in next year. Proportionate growth rate will be in dividend also. In that case, D1 is equal to next year dividend is equal to D1 is equal to yes D0 6 is D0. 6 is D0. Company got the dividend previous year dividend 6 rupees. Investor is expecting dividend some growth in next year. That is called expected dividend D1. D1 is equal to D0 into 1 plus G. D0 is 6 rupees 1 plus 0.10. That is equal to 6 into 1.10. 6 into that means 6.6 rupees is expected dividend. D1 is expected dividend. Clear? D1 is expected dividend. Clear? D0 current dividend or previous dividend. Current dividend paid. Dividend paid. D0 means if question gives you dividend paid 6 rupees, then you should consider as D0. Clear? Suppose question gives you expected dividend is 6 rupees. Then you can consider as D1 is 6. Clear? Clear? Okay. G, growth rate in earnings and dividend. Growth rate in earnings and a dividend. Growth rate in earnings and a dividend. G is equal to, yes, G means growth rate. Every company has some growth in each year. That rate is called growth rate in earnings and dividend. Then how to find out this growth rate? B into R. B into B is equal to retention ratio. B is equal to already we discussed in previous formula the retention ratio 40%. EPS is rupees 10. Rupees 10. Okay. 60% dividend payout ratio. 40% is called retention. 6 rupees DPS. That is D0. Okay. 4 rupees is called retained earnings per share. Retained earnings. Earning per share. Okay. If this 40% is called a retention ratio. What is? How to find out retention ratio? 1 minus dividend payout ratio. Dividend payout ratio is 60%. 1 minus 60% 40%. Clear? 1 minus 0.60. 0.40 is retention ratio. Clear? Okay. Then we got retention ratio is 40% or 0.40. What is R? R means return on equity. Return on, suppose company has returned 20% return. Company has returned 20% return. Company has return of 20%. Then growth rate will be 20 into 0.40. B, retention ratio is 40%. Our return is 20%. 20 to 40.4. 20 into 0.4. 8% is growth rate. 8% is growth rate. Clear? Suppose company is having return on 20%, return on equity 20%, then R is equal to 20%, B is equal to 40%. 20% into 0.40, 8% is growth rate. Clear? Each year company has constant growth of 8%. Year at the end of year 1, 8%, year 2, 8%, year 3, year 4. Each year company expects that there is a growth rate of 8%. Clear? Yes. Then how to find out this formula? Yes, as we know, P0 is equal to market price is equal to rupees 80. Rupees 80. Previous example, we consider as 80 rupees. D1 is equal to, what is D1? 6.6. D1 is equal to D0 into 1 plus G divided by P0 plus G. Clear? D0 plus 1 plus G. D0 into 1 plus G is 6.6. 6 rupees is D0 into 1.1. 1.1. 1.1 is growth rate. Clear? Just we expected 10% is growth rate. Okay, growth rate. Clear? Okay. Yes, suppose 10% is the growth rate. Yes. This example a little bit. Okay. 10% is growth rate. Okay. 6.6 divided by P0. What is P0? 80. Plus G. G. Question already gives you G is equal to 10%. 10%. Point 0.10. 0.10. Just calculate 6.6 divided by 80. Plus 0.10. What is it? 0.182 or 18.2%. 18.2% is the K. Clear? Here question gives you G is equal to 10% or 0.10. Suppose question does not give G growth rate. You have to find out G. How to find out G? B into R. B is equal to retention ratio. R is equal to return on equity. Return on equity. Then B can be, we can find out 1 minus dividend payout ratio into return. Clear? Yes. Dividend growth model formula K is equal to D1 divided by P0 plus G, where D1 is equal to expected dividend, D1 is equal to D0 into 1 plus G, G is equal to growth rate in earnings and dividend, G is equal to B into R, B is equal to retention ratio, that is 1 minus dividend to payout ratio, R is equal to return on equity. Next, fourth method, CAPM, capital asset pricing model. Capital asset pricing model. Okay, listen here. When we consider this third method, if question gives you growth rate, you should consider as dividend growth model. K should be found out based on dividend growth model, or you can give retention ratio and a return on investment or return on equity. In that case also you can find out by using this formula growth rate. Then also you should consider this formula dividend growth model. Clear? If question gives you the details of G or any details regarding the computation of G, then you should apply dividend growth model. Clear? Okay. CAPM model, capital asset pricing model. Capital asset pricing model, K is equal to RF plus beta into R minus RF. What is the formula? Repeat. K is equal to RF plus beta into RF minus RF. RF minus RF means risk-free return. Risk-free rate. RF means risk-free rate. RF is equal to return on market portfolio. Return on market portfolio. Return on market portfolio. RF minus RF is equal to market risk premium. Market risk premium. Market risk premium. Yes. First of all, study this formula, then once again we will discuss this concept again. Yes, listen here. Concept of CAPM model. K is equal to RF. RF means risk-free rate. Risk-free rate into RM minus RF into beta. RM is return on market portfolio. RM minus RF is equal to market risk premium. Suppose listen here. Suppose I have 1 crore rupees. 1 crore rupees I can invest in scheduled bank like SBI. If I invested in or State Bank of India or SBI, I can get 7% return. That 7% return is called 7% return is called a risk-free rate of return. Otherwise, treasury bill, government treasury bill, treasury bond or treasury bill. If I invest, I can get 7%. The treasury bill interest rate is called risk-free rate. Clear? I don't want to invest any other business. I can invest that 1 crore rupees to treasury bill, treasury bond. I can get 7% return. That 7% return is a risk-free return. Clear? If I am investing in some other business, there is a business risk is there. Clear? If I am investing in some business, I am expecting more return. Actually, I am expecting more return. Hence, I am investing into business. Clear? Suppose I am investing in some software business. Software business. So, if software companies, lot of software companies, Infosys, Wipro, and other small companies in our town also, software companies. If we invested in any software company, that software company has a market return, average market return will be there. Clear? Definitely, there will be a average market return for that software company. If you invest in any software company, there may be average return will be there. That average market return is called return on market portfolio. Return on, suppose average return for any software company on an average 15%. Average return is 15%. Clear? Clear? Then what is the extra benefit I am getting from this investment of a software company? 7% is a risk-free return. 15% I can get it from the software company. If I invest in a software company, that means extra benefit I am getting 8%. 8% is called a market risk premium. 8% is called a, yes, 8% is called a market risk premium. How we got this 8%? 15% minus 7%. 8%. RM minus R, 8%. Market risk premium. Because of I am investing in this software company, I am getting an extra benefit 8%. 8% is called market risk premium. RF is 7% plus RM minus RF is 8%. Clear? Then what is beta? What is beta? Beta means each industry's beta will be 1. Industry beta will be 1. Suppose all software company they'll get same return. They all software they won't get the same return. Suppose Infosys will get a return of 30%. In our town, small software company we have that company will get only 10% return or 12% return. On an average, software company will get 15%. Clear? Industry's beta will be 1. Company to company, the beta may be changed. Beta may be, software companies beta will be 2. So Infosys companies beta will be 2. Okay, small companies beta may be 0.75, 0.8, some case 1.25. Like company to company, the beta will be changed. Okay, the beta details will be given in question. Okay, Beta you don't compute this beta. Beta computation you will study in final. Say final. Okay. Beta, suppose beta will be 0.75. Beta will be 0.75. Then k is equal to 7 percentage plus 8 into 0.775. 8 into 0.75. 6. 7 plus 6. 7 plus 6. 13 percentage is k. Clear? Clear? I hope you got this idea. Clear? What is the under CAP model? K is equal to RF plus beta into RM minus. Okay, but you should careful. Question directly they gives market risk premium. In that case, you should take 8%. Okay. Some case you may give return on market portfolio. Return on, instead of giving market risk premium, they may give return on market. If return on market is given, return on market RM minus RF you should find out. Question specifically given market risk premium. Risk premium, you should consider RM minus RF. Clear? Okay. Clear? The question gives you risk-free return details, beta details, market risk premium or market return. In that case, you should follow CAPM model. Clear? Clear. Yes. Yes. This concept, once again, we will discuss this K concept, cost of equity. When capital is obtained from debenture holders, we need to pay interest. We need to pay interest. Company have to pay interest. If from preference shareholders, we need to pay preference dividend. Preference dividend. However, there is no compulsion to pay dividend to equity shareholders, and their capital also need to be paid at the time of winding up. Actually, there is no compulsion to pay dividend to the equity shareholders. The capital also can be paid at the time or repaid only at the time of winding up of the company. Okay, so can we say cost of equity is 0? Can we say cost of equity is 0? Cost of equity never be 0 because every investor they have some expectation of return. If they don't have any expectation, they won't invest. Clear? Yes. We cannot say that there is no cost of equity or cost of equity is 0. Clear? Okay, there is no, because if we issue debentures, debenture itself mentioned that 10% debentures. That 10% is the explicit cost to the debenture. Clear? If we issue preference dividend, it will mention 12% of preference shares. The 12% explicit cost of preference shares, but there is no explicit cost for equity shares. Clear? But there is an expectation from the point of view of investors. That expectation, if we quantify it as a percentage, is called cost of equity. There is no explicit cost for equity, but it has implicit cost. It has implicit cost. The cost of equity is the expectation of equity shareholders from the company. Cost of equity is the expectation of the equity shareholders from the company. That expectation can be understood through the investors' behavior in the stock market. Investors' behavior in the stock market. Example. Yes, listen to this example. If a company report an EPS of rupees 3, EPS of rupees 3, and share is trading in the stock market rupees 30, market price of share is 30, EPS divided by MPS. What is K under constant earnings approach? 3 divided by 30, 10%. 10% is K. K is equal to 10%. Clear? It means that investors are expecting 3 by 30, 10% from the company. This is called cost of equity. This is called a, if a company earns more than the expected 10%, say rupees 4 EPS, then market price will increase to rupees 40. Market price will increase to rupees if the company earns more than the expected 10 percentage. If the company earns more than the expected 10%, rupees 4 EPS. If the company earns 4 rupees EPS, automatically market price will increase to rupees 40. Clear? On the other hand, if company earns less than 10%, say 2 EPS, 2 EPS, then the market price decrease to rupees 20. That means from the viewpoint of investors' behavior in the stock market, we can analyze the KE, cost of equity, clear, or the market price of shares, clear. Next is KR, cost of retained earnings, cost of retained earnings. Company can use its own profit for new investment. Company can use their own profit for their new investment. Using my own money is free of cost. Free of cost. Correct? Using my own money is free of cost. R is equal to KR is equal to 0%. True or false? True or false? KR is equal to 0%. True or false? True. True. Retained earnings is shareholders' money, not company's money. Shareholders' money. Money belongs to equity shareholders. Money belongs to equity shareholders. Then KR is equal to KE. KR is equal to KE. KR is equal to K. Clear? That means questions gives you KR. KR. That case, KR is, you should consider KR is equal to K. Sometimes KR may less than K. Sometimes KR may less than K. Less than K. When suppose, listen here, KR is equal to KE into 1 minus flotation cost. Actually, suppose company need 10 crore rupees for new investment. Company need 10 crore rupees for new investment. Company has two options. Either can issue fresh shares, new shares, fresh shares, or they can utilize retained earnings. They can utilize. If the company issue fresh shares, company needs to pay brokerage or some other expenses. That means company needs to spend cost of issue for fresh issue. Cost of issue will be there. But company using my own money or retained earnings saves cost of issue. Cost of issue or flotation cost. Saves cost of issue or flotation cost. If company use company's money as new investment, company saves rate flotation cost. If they issue new shares, they need to spend flotation cost or cost of issue. Suppose 2% is cost of issue. Assume 2% is cost of issue. Clear? 20% is K. 20% is K. Yes, 1 minus flotation cost 2%, 0.02. That means 20 into 0.98. Calculate 20 into 0.9. 20 into 0.98. 19.6% is KR. K is 20%. Questions specifically given there is a flotation cost. This much percentage. In that case, K into 1 minus flotation cost. Clear? 1 minus 98%. Clear? Suppose for this fresh issue, company has to pay 5% brokerage. 5% brokerage. If the company using retained earnings, company does not pay brokerage. In that case, brokerage also we need to reduce 1 minus brokerage. 1 minus, yes, 1 minus 0.05. Clear? 1 minus 0.05. Clear? Okay. Suppose, yes, then if company uses fresh issue of shares, company issue fresh issue, in that case company needs to spend flotation cost, brokerage. If company using retained earnings, company can save flotation cost and brokerage, hence it will be reduced from the scale. Clear? Okay, then 1 minus TP. TP means personal tax. Suppose if an investor he got this full company is not maintaining retained earnings. So suppose example company is not maintaining retained earnings. Full amount EPS earnings will be distributed among the shareholders. If the shareholders after receiving this return invested some other investment or somewhere else. From that investment, if the shareholders get any return, he has to pay personal tax. He has to pay personal tax. Personal tax. But if the company using retained earnings for their new investment, yes, shareholders can save personal tax. Shareholders can save personal tax. Hence, 1 minus personal tax. 1 minus, suppose personal tax is 30 percentage. 1 minus 30 percentage. Clear? Okay. So, if the company using retained earnings, KR may be less than KE. In C, three situations are possible. If the company has flotation cost, brokerage, or personal tax. Our questions gives you flotation cost, brokerage, or personal tax. You should reduce from K. Formula will be KR is equal to K into 1 minus flotation cost into 1 minus brokerage into 1 minus personal tax. Yes. Listen here. FC is equal to flotation cost, BR is equal to brokerage, and TP is equal to personal tax. Personal tax. Write it. Cost of retained earnings. Retained earnings are accumulated profits of the company. Accumulated profits of the company, which can be used as a source of finance. Accumulated profits of the company, which can be used as a source of finance. Retained earnings belongs to equity shareholders. Therefore, using retained earnings is same as using equity shareholders' money. Retained earnings belongs to equity shareholders. Therefore, using retained earnings is same as using equity shareholders' money. The cost of using shareholders' money is K. Therefore, K is equal to KR. However, sometimes KR may be less than KE due to the following reason. Three reasons. Raising money through equity shares involves flotation cost. But retained earnings usage does not have flotation cost. There is no cost of issue for using this retained earnings. If the shareholders receive dividend and invest elsewhere, he has to pay brokerage for making such investment. For making such a investment. If the shareholders receive dividend and invest elsewhere, some other place they are going to invest, he has to pay brokerage for making such investment. But foregoing dividend, company making retained earnings means foregoing dividend and allowing retained earnings to be used by the company does not have brokerage. Clear? There is no brokerage. If the company uses retained earnings, there is no brokerage in simple term. Okay. The shareholder suffers personal tax when if he invests his own. But if he allows the company to invest through retained earnings, the profit earned and distributed as dividend is exempt from tax. Suppose if an investor invests his own his own self. Suppose investor is getting dividend, company is not maintaining retained earnings, full amount is distributed as dividend. Then this investor, he is investing somewhere else, his own. Then he suffers personal tax. If company to invest through retained earnings, if he allows the company to invest through retained earnings, the profit earned and distributed as dividend is exempt from tax. Clear? Therefore, KR is equal to KE into 1 minus protection cost, 1 minus brokerage, and 1 minus personal tax. Yes, right on. Okay, we completed KD computation, KP computation, KE computation, KR. Okay, then the specific cost of capital computation is over. Now we are moving to overall cost of capital or weighted average of capital. Weighted average cost of capital back. Yes, if company raise finance only from equity, its cost of capital is K. If company raise finance only from equity, its cost of capital is K. Only through debt, its cost of capital is KD. Clear? And so on. However, company can raise money from all three sources in different proportions. Suppose company raise capital 10 crore rupees, 5 crore from equity share capital, 2 crore from preference share capital, and again 3 crore from debt fund. That's all the three sources company raise fund. In such a case, the cost of capital to the company is weighted average cost of capital KO or overall cost of capital. It is also called overall cost of capital or composite cost of capital. Composite cost of capital. Clear? Yes, overall cost of capital. That is called weighted average cost of capital. Clear? Weighted average cost of capital, if the proportions are calculated using book value, suppose 10 crore capital we raised. 10 crore capital we raised. Clear? Out of equity share capital 5 crore. Yes, preference share capital 2 crore and debt fund 3 crore. Total 10 crore raised. Clear? This is actually book value. Book value. This is actually book value. 5 crore equity share capital raised. This 5 crore rupees is book value of equity share. This 2 crore preference share capital and 3 crore book value of preference share capital and debt fund. Okay. Then this proportion or weight, proportion. This 10 out of this 10 crore, 50% is equity share capital, 20% is preference share capital, 30% is debt fund. This is called proportion of total investment. Clear? Yes, this proportion can be computed based on book value weights. Okay, proportion can be computed based on or market value weights Suppose equity share capital, this is 5 crore is book value. Suppose the market value of this equity share capital is suppose 8 crore. Market value is 8 crore. Clear? Preference share capital market value is 4 crore. Clear? Debt fund market value is suppose 4 crore. Assume. Just assume. In that case, total 16 crore is total market value. Market value is 16 crore. Clear? This proportion is computed based on this market value. That market value, then that proportion is called a market value weights. Market value weights. Clear? This weighted average cost of capital can be computed either based on book value or market value. Either based on book value or market value. Clear? Yes. If the proportions are calculated using book value, the weights are called book value weights. If the proportions are calculated using market value, the weights are called a market value weights. Clear? Yes. Question number 19. Question bank question number 19. Please read that question. One or twice. Question number 19. Question back. The following is the capital structure of the company: book value, source of capital, and market value. Equity shares of rupees 100 each, 80 lakhs, 1 crore 60 lakhs. Market value. 80 lakh is the book value of equity share, 1 crore 60 lakh is the market value of equity share. 9% cumulative preference shares are released 20 lakhs and 24 lakhs. 11% debentures 60 lakhs, 66 lakh. Retained earnings 40 lakhs. Total 2 crore and 2 crore 50 lakhs. The current market price of the company's equity shares is rupees 200 rupees. Current market price of equity share is rupees 200. For the last year, the company had paid equity dividend at 25 percentage. Last year, dividend paid 25 percentage. Its dividend is likely to grow 5 percentage year. 5 percentage year. The corporate tax rate is 30 percentage and shareholders' personal income tax rate is 20 percentage. You are required to calculate cost of capital for each source of capital. Cost of each source of capital means compute KE, KP, KD, and KR also. Normally KR is equal to K. Here company give personal income tax is given. That case KR may be less than K. Okay, KR is equal to K into 1 minus personal tax. Clear? Okay. First of all, any weighted average cost of capital question, you should find out the specific cost of capital first. First step is computation of specific cost of capital. But in this question, main question itself, they ask cost of capital for each source of capital. First you find out K, KP, KD, KR. Okay. Then second, weighted average cost of capital on the basis of book value weights. Weighted average cost of capital on the basis of market value weights. Yes. Then next question is K, which formula you should use? Which method you will find out K? There are 4 methods we already discussed. Constant earnings approach, EPS and MPS only gives in question. Constant dividend model, DPS and MPS is given. Growth model, G in question, G growth rate is given. Yes, CAPA model. In this case, in this question, which method you will follow? Growth rate is given 5 percentage. 5 percentage? Yes, what is the formula of growth rate? K is equal to D1 divided by P0 plus G. Clear? Okay. These are, yes. Then, calculation of cost of capital for each source of capital. Cost of equity share capital. Cost of equity share capital, that is KE. K is equal to D1 divided by P0 plus G. What is D1? D1 divided by P0 plus G. Find out. K is equal to D1 divided by P0 plus G. D1 is equal to expected dividend. Expected dividend. Expected dividend. D1 is equal to D0 in 1 plus G. Question specifically gives you that 20% current year or dividend paid during the year 25%. Dividend paid means D0. D0. 100 into 25% D0. 100 face value is 100 per share into 25% into 1 plus G. G 5%. 26.25. G is equal to growth rate. 5% growth rate, 5%. Then 26.25 divided by 200 plus 5%. 5%, you should write it as 0.05. Clear? Then answer will be 18.125%. You will get it 0.05 18125 or 18.125 percentage. Clear? K is 18.125 percentage. Okay. Then cost of preference shares. KP is equal to, what is the formula KP? Redeemable debenture or irredeemable? Question does not give this redemption period. Okay, then it is a irredeemable debenture preference shares. That means 9%. PD divided by, what is that? KP is equal to PD divided by SB. What is PD? 9. SB 100 into 100. That means 9%. Clear? KP is equal to 9%. Okay. If issue price is changing, then percentage may be different. Otherwise, the same percentage, KP is equal to same percentage. Clear? Yes. Cost of debenture, I into 1 minus T divided by SV. Irredeemable. Irredeemable debentures. Yes. KD is equal to I into 1 minus T irredeemable divided by SV into 100. Then answer will be I is equal to interest, T is equal to tax rate. That case 11 into 1 minus point tax rate 30, that is equal to 7.7 percentage. 7.8 7 percentage 7.7 percentage. Clear? I already told you that if company issue the debentures at the same face value, in case of irredeemable debentures, the formula will be I into 1 minus T. I into 1 minus T. Clear? Yes. KE we found out. KP we got it. Then KD also we got it. Next, KR is equal to KE. But in this case, KR, here personal tax is given. In that case, KE into 1 minus personal tax. K into TP is equal to personal tax. K into 1 minus personal tax. Personal tax is 20%, 0.20. That is 14.5%. 14.5%. Clear? K is 18.125. KP 9%. KD 7.7%. KR 14.5%. Clear? That means first question's answer is over. Next one, weighted average cost of capital on the basis of book value weights. Book value weights. Next question, sir. Question answer. Computation of weighted average cost of capital. For this, you should follow a format. In this format, first column is source of capital, amount, weight or proportion, cost of capital percentage, weighted average cost of capital. Columns, repeat, source of capital, amount means book value or market value. This is a book value case, book value. Okay, weight, cost of capital, weighted average cost of capital. Clear? There are source of equity shares, 9% preferred shares, debentures, and retained earnings. Clear? Book value. This is book value. Yes. Refer your question. What is the book value of equity share? Check it out. 80 lakhs. Preference shares? 20 lakhs. 11% debentures? 60 lakh. Retained earnings? Total? 2 crore. Weights, proportion. 80 divided by 200. 80 lakhs divided by 200 lakhs. 80 divided by 200? 40%. 40.40. 20 divided by 200. 10%. Next day, 60 divided by 200. 30%. 40 divided by 200. 20%. Then this overall weights will total will be 1. It should be 1. Correct 1. It should be there. Clear? Then cost of capital. What is K? K. 18.125. Yes, 18.8. 9% preference shares, debentures 7.7, retained earnings 14.5. Clear? Zero point 4 into 18.125. Calculate. 18.125 into 0.4. 7.5. 9 into 0.1. 0.9. 7.7 into 0.3. 2.31. 14.5 into 0.2. Then add all those things, all those items. Add it. Total 13.36. This is weighted average cost of capital. Percentage is 13 point. This is the answer. 13.36. If it is a book value weights, weighted average cost of capital will be 13.36%. Clear? Then what is the difference in book value weights and market value weights? Here we considered book value weights. Okay. But in case of market value weights, there is only small difference. This column will be changed. Instead of book value weights, we should consider market value weights. Market value weights. Clear? Okay. Weighted average cost of capital on the basis of market value weights. Same column. Source of capital, amount, weights, cost of capital, weighted average cost of capital. Yes. Listen here. Here one more point you should remember. Yes. Source of capital are equity share capital, 9% preference share capital, debentures. Retained earnings is not considered as a source of capital under market value weights because market value includes retained earnings. Actually, retained earnings belongs to equity shareholders. Because of these retained earnings, market value of equity shares is increasing. Clear? Market value of equity shares includes retained earnings. Hence, retained earnings separately not considered. There is no separate market value for retained earnings. Clear? In that case, yes, market value equity share 1 crore 60, 24 lakh, 66 lakh. Clear? Total 2 crore 50 lakhs. Weight 160 divided by 250, 0.640. 24 divided by 250, 0.096. 66 divided by 250, 0.264. Cost of capital, same. Listen here, same cost of capital. You should put here. Weighted average cost of capital. 18.125 into 0.640, 11.60, 9 into 0.096, 0.864, 7.7 into 0.264, 2.033. Then weighted average cost of capital is 14.497 percentage. 14.497 percentage is weighted average cost of capital under market value weights. But here one point you should remember, under market value weights, retained earnings is not considered. Okay, this point okay. Fourth point, when we calculate market value weights, retained earnings as a source will not be there because the market price is the value both for capital and retained earnings. Market value is the value. Market price is the value for both capital and retained earnings. Clear? Yes. Hence, retained earnings separate. There is no separate market value for retained earnings. Usually, market value represents the true value of capital. Market value represents true value of capital, but market value actually listed shares we have market value. Unlisted shares we don't have any market value. But for unlisted companies whose shares and debentures are not trading in stock exchange, the only value available is book value. The only value available is book value. Clear? This is the introduction to weighted average cost of capital. Clear? Some additional points we need to discuss in some other problems also.